Imagine turning $2,500 into $5,000 or losing it all. That's the power and risk of trading on margin. Listen, should you play it safe with a cash account or supercharge your trades with a margin account? Today, we're going to break down the key differences so you can make the right choice for your trading goals and avoid costly mistakes, okay? So I'm going to start out with margin, okay, because a lot of people are attracted to it. It's the shiny object, right? Let's talk about what margin is, because a lot of people don't realize this. So when you get a margin account, there's a lot of kind of baggage that comes around along with it, but it has advantages, okay? What margin is, let's say you put $2,500 into your brokerage account. Most brokers, not all, but most, start out with 4-to-1 leverage on a margin account, which means even though you've got $2,500 in your account, you could actually trade $10,000 worth of stock, which sounds awesome, right? Instead of buying 100 shares, I'm buying 500 or 1,000. And that's where people kind of get in trouble, because they kind of see the fact that now, instead of buying a small position, I can buy a pretty good big position, okay? Which everybody instantly takes and doesn't think about it. Now that's great if the trade goes in your favor, okay? If you use your margin, let's say you, instead of making a $1,000 account, or $1,000 trade, now you make a $6,000 trade or a $7,000 trade because you've got that buying power, is what it called, of $10,000. Now trade goes in your favor, woo-hoo, right? That's the awesome part. But then you can just trade normally with margin, sell your stock where you're happy, book your gains. This is where a lot of people get in trouble. Margin cuts both ways, because since you have a bigger position, you're leveraged up. Your gains are magnified, okay, when you win, but your losses are magnified as well. Margin doesn't just work one way, and I think that's what trips up a lot of people. They think about the big gains, and they don't realize they're leveraged on the downside. So if you're trading, let's say you're crazy, okay? Let's just assume, worst case scenario. You use all your 4-to-1 leverage. You go all in on a trade with all your leverage. Stock goes in your favor, your gains are 4x'd, okay? 4x'd what you have in your account. Awesome, but your losses are 4x'd as well. So when that stock starts falling away, now, as it drops and you're in the red, your losses are magnified by that same 4x. That's why a lot of people really get in trouble in margin. Like, historical example. I'm sure all of you remember like the great stock market crash in the 20s and people jumping out of buildings and literally committing suicide. If you ever wonder, like, well, why were they jumping out of buildings? Those were the people that had massive leverage. And they went from, losing all their money to actually owing, okay? Because they're leveraged up with their broker. And now it's not just calling the wife or the husband and saying, hey, lost all the money in the account. It's, hey, I lost all the money in the account and we owe the brokerage company 20 grand. And these guys, they're aggressive. They bust some kneecaps, okay? So that's why you always heard these stories of people jumping out of the building, because they didn't just lose all the money, they owed money on top of that, and a lot of them had no way to make that money back. So think about the stress of that. So always understand that margin is awesome if it goes in your favor, but it also goes against you. Now, the other things with a margin account that a lot of people don't realize is if you're trading on a margin account with less than $25,000 of cash in your trading account, it binds you to the pattern day trader rule, AKA the PDT. Now, when I talk of the PDT, I always like to mention one of my favorite Ronald Reagan quotes of all time. He was a quote machine, but he said, the 9 most dangerous words in the dictionary are, I'm from the government and I'm here to help. Listen, I think the PDT is idiotic. It's the dumbest thing ever. It was created after the dot-com boom. In the government's infinite wisdom, they were going to protect traders from themselves. But what a lot of you realize is you now make bad decisions because of the PDT. Like it literally does the exact opposite of what it was intended to do. The whole point was calm people down, make them trade less. But now people make crazy impulsive decisions because they got that last day trade and they want to maximize it. Like, actually, let me know in the comments. Have you ever been there? You're down to your last day trade. You know you got 3, 4, 5 days before you can trade again. Did that influence your thinking? Like, did you trade bigger size or maybe just chase stuff because you're like, well, after this trade, I can't trade for 3, 4, 5 days more? Or, and this is the one that I think gets people constantly in trouble, and this is maybe my biggest warning of a margin account, is you start holding overnight when you know you shouldn't. Because with the PDT, it's just a round trip in the same day. So if you buy and sell the same stock in the same day, that's a day trade. If you hold overnight, now you're free from that. So what happens, and again, drop me a comment if you've done this, okay? You now have a losing position, stock is fading into the close, and you end up holding it even though all the alarms are ringing. You know you should cut that loss, but you don't want to burn that day trade. Then what happens 9 out of 10 times, literally 9 out of 10 times, that stock gaps down the next day because it closed so weak. And now instead of losing, say, 10%, you lose 30, 40, 50%. And it was all because of the PDT. Now, you made the decision. You decided to hold it overnight, own your mistakes and respect that. But we all know that a lot of that decision was influenced by the fact that you didn't want to use that last day trade. So understand PDT and margin cuts both ways. Now let's talk about cash counts. Now there's no free lunch, as they say. I really beg new traders, like if you're brand new, just trade with a cash account. Now, people think, oh, you know, I can't leverage up, I can't short sell. That is one thing I do want to say. You do have to have a margin account to short sell, okay? You cannot short stocks with a cash account. But let's go back through these things, okay? Like when you think about pros and cons of cash versus margin. Cash account, no leverage. Well, if you're brand new, leverage is just going to make it worse, okay? You're going to be impulsive. You're going to make bad trades. You're probably going to hold losers. You're going to make all these mistakes in the beginning. So think about it. Would it be better to make those mistakes with small positions, not leveraged up? Like if I'm going to make a trading mistake, think about leverage. It's like gas on the fire, okay? I'd rather have a small controllable fire that I can put out with a wet towel versus an explosion. So margin trips you up there. The other thing, nice thing about cash counts, no PDT, okay? You can, as long as you have enough cash in your account settled, you can trade freely, okay? So especially if you're brand new, I tell you, trade puny positions, way smaller than you eventually plan on trading. With a cash account, you can do that. You can trade one share, kind of get used to the price action, the wild moves that these stocks make. Maybe you trade 10 shares. Now, I know what you're going to say. A lot of you right now are saying, well, how am I going to make any money with 10 shares? What I beg everyone to do is focus on your percent gain, the quality of the trade, not the dollar amount in the beginning, okay? Now, I know you're all here to learn how to make money, and making 10 bucks or 20 bucks, whoop-de-doo. But when I see people just getting started, let's say you buy a $1 stock and you sell it $1.50, it's a 50% gain, and let's say you make 50 bucks, okay? Is 50 bucks going to change your life? You're going to retire? You're going to travel the world? No. But I always tell people when you're tracking your data and you're reviewing, that's a great trade, okay? You made 50% on a day trade. Pat yourself on the back, learn from that, and then a month later, 2 months, 6 months later, now you're trading 1,000 shares instead of 100, okay? So take your time, do it well, and a cash account is a great way to do that, okay? Now, big drawback to cash account, as I mentioned, you can't short sell. Now, in my opinion, I've been short selling for 20 years. I don't consider short selling advanced, but I do consider it intermediate, okay? Like at the end of the day, with short selling, you're just reversing, you're selling and then buying, collecting the difference. Like a lot of people don't realize this, but when you short sell, you're still buying low and selling high, okay? You're just reversing the order. So it's not really any different. It's just when you're shorting, these stocks can go up way faster than they go down frequently. And if you're on a margin account, that means you got margin. that means, you're magnifying your losses. And when that trade goes against you, it can get really ugly real fast, okay? So in closing, choose what's right for you. I would make this recommendation. If you're brand new to trading, you don't need margin, you're probably not ready to short sell yet, and who wants to deal with the PDT at the end of the day, especially if you're trying to get your feet wet? Like, wouldn't you rather be able to make 3 or 4 trades a day versus 3 and 5 day period? Okay. So that's my recommendation. Now, some of you might be more advanced. Maybe you're profitable. Like, that's the cutoff to me. Like, you might be asking, Tim, where's the cutoff? Where do I transition from a cash to a margin account? That would be my thing. If you're consistently profitable, doesn't mean you win on every trade. But if you're starting to see your account grow, there's always going to be dips, but the dips are a little smaller. The dips don't wipe out all your gains where you go back to 2 months ago. If that trend, and you're tracking your data, you see that trend start to rise, you see consistency, then, my friend, you're ready to upgrade to a margin account. You get the leverage, you get the ability to short sell, and if you're growing your account, you won't be under 25,000 for long. And once you're over 25,000, the PDT goes away as well. So then you can harness the advantages of a margin account. So let me know in the comments below. What are you using? Cash, margin? What are some of the pros and cons to each? And the last thing I would say is, if you want to get really in depth in all of this, like some of you might have never heard of a cash margin account or never heard of some of the the baggage that comes along with each, you can check out the Daily Income Trader System. I do 2 live webinars a day. We actually have 5 live webinars a day in the entire system. I do 2. And we have guides and in-depth courses on all of these kind of intricacies that you might not know. Hit that link below. Check it out. It's a free tour of the Daily Income Trader System. You can see if it's right for you.